Hey folks, Joe Valley here with my co-host, Pat Yates. Welcome back to another episode of the Quiet Life podcast. Pat, how you doing today?
Doing great, Joe. How are you?
Doing well, man. This is an interesting podcast that we just did. This is our first broker roundtable. We're going to try to do this once a month or so. And we've got two of the most epic brokers at Quiet Life, Brad Wayland and Chris Wozniak, talking about all sorts of things, right? We're talking about buyer behavior now versus 21, seller behavior, multiples, interest rates, all sorts of things. Right. A lot of experience. You piped in a little bit there as well, right?
Yeah, definitely. I mean, I had some stuff to add to it, but the opportunity to listen to Woz and Brad talk is just really incredible. So much experience and guys have closed so many big deals. I mean, it's hard to imagine being able to talk to two guys that have closed more 8-figure plus deals. It's incredible. They have their pulse on the market and they really understand. I learn stuff from them every day. If people, we keep repeating it. We have some of the best advisors in the world that work at Quiet Life. Like an MBA every time you talk to them. It's just amazing.
And the key thing we do, always go back to the data, because sometimes it feels like it's taking longer to close deals. It's not. It's 54 days from LOI to close in the last 3 months versus the first 3 months of 2021, which was 58, right? Yeah. It's that feeling is strange. Like it feels like multiples are down. They're actually up a little bit in certain segments. FBA businesses that are trending down. Hey, surprise, those multiples are down, but they're trending down, and it's a very small niche. So lots of good information. These two are full of wisdom and experience. They can both be reached, Brad at quietlight.com, Woz at quietlight.com, and of course you, Pat at quietlight.com.
There you go.
We at the end of the podcast, folks, we talk about what they're working on, and if any of what they're working on sounds of interest to you, just reach out to them directly. All right, here we go. Brad and Chris, how are you guys?
Good.
But I didn't know that's what you meant. I thought you were talking about the word intro. Go ahead. Anyway.
So Pat's asking me, folks, how to do the intro, and that's it. I'm welcoming Chris and Brad to the podcast. Pat is co-hosting, and this is a broker roundtable where we're going to talk about all sorts of things, mostly comparing 23 year to date to how 21 was and what it's like to get lending and multiples and things of this nature. But first and foremost, Woz, you're in Texas, right?
Yep, Dallas, Texas.
And Brad, you used to tell me you were in Nashville, but you're actually in Bowling Green, Kentucky.
I said north of Nashville.
Okay, north of Nashville, which technically is correct.
About 50 miles north of Nashville.
Good.
All right. It's a great city.
Well, between the three of you guys, you probably produced the majority of Quiet Light's revenue and closed transactions in the last 12 months. So even though, Pat, you're co-hosting with me, I want you to put your broker hat on here too, okay?
Yeah.
Fair enough. All right, Brad, why don't you kick it off? What's going on this year compared to last year in 2021, a record year?
Yeah, sounds good. It has been it's funny, we didn't put the year 2022 in there, which is the year in between. And, it's interesting when you're brokering deals, it's painful when you're in transition. And so I really think as we look at 2022, I would call 2022 for me a big year of transition in terms of things changing. But I think we want to talk a little bit about those two ends, 2023, versus 2021. I don't know if everybody else kind of sees it this way, but I really think back to 2021 is like peak euphoria for buyers in terms of what I've seen in almost 20 years of kind of being in this industry and being in the buying and selling and brokering deals space. In 2021, money seemed to be flowing more freely than it ever had in my entire lifetime. Lending was very loose. Interest rates were zero or close to it. And so what we saw on that was just behavior that I actually at the time thought, man, you got to really appreciate these bull runs. If this could last for like 5 years, that would be amazing. But it seems like the euphoria ends a lot quicker than you want it to. And so, from my personal experience, in 2021 was a year that I wasn't even working as heavily as I had been, because I had closed a lot of deals in 2020 and really wanted to take some time off. But I had a bunch of carryovers, and they were some of the easiest closings I ever had. And really just did not have trouble finding buyers for just about anything. And I think that had to do with a lot of factors. I think it had to do with a lot of the things that were going on with COVID and the after effects of COVID. A lot of loose monetary policy. They injected a lot of liquidity into the system. And so, as we look at 2021, I think that we were seeing that when there's a lot of liquidity in the system, that risk assets and assets in general start to go up in value, and people are willing to be pretty aggressive, in terms of buying them. On the flip side, for me in 2023, after going through kind of coming down in 22, what I'm seeing now is kind of a flight to quality. I feel like definitely the monetary policy is tighter, and that has affected how deals are closing, the speed of which they close. We can dig into those things more in this, I'm sure, but I'm definitely seeing a much more measured buyer that's wanting to kind of like consider the cost of what they're going to do. But we are seeing buying activity, and I think that we've seen a really nice positive uptick. I've seen it since about mid-December with my deals. And so in 2023, it's starting to look more like business as usual to me. And I would call 2021 more of an outlier. 2023 looks more like what I was used to in almost 6 years at Quiet Light, doing these deals. So that's kind of how I would kick it off as like a general comparison. Chris, what do you think about that?
Yeah, I agree. I think you almost have to talk about Amazon a little bit, FBA, because I think clearly, with the aggregators and all that committed capital, I think it created kind of clearly like a bubble. And so, 2022 from that standpoint, I think was down. I know me personally, anecdotally, I think I did 10 or 11 deals in 2022, and my 22 was better than my 21, and 21 was great. And out of my deals, I think I did 2 FBA deals. And so I think the market is still really strong for, whether it be straight up e-commerce. SaaS businesses are always sought after, content sites, and still, Amazon deals are getting done. When I look at like multiples, I haven't seen too much of a downward trend in multiples, if any at all. And that's hard to really say because it's sort of like on a case by case basis. If the business is trending down because we're in a kind of historically inflationary period and interest rates are high, and there's businesses out there where the trends are down. I mean, it's kind of expected that those particular businesses, the multiples are going to reflect that kind of downward trend. But on the flip side of that coin, where you find businesses that are thriving, where they're having either they're kind of normalized and stable or even growing, you could almost make the case that you can almost showcase those businesses and kind of maintain a multiple that's similar to 2022 or 21, or maybe even give it a little bit of a premium, just because that those businesses that are experiencing positive trends are competing with businesses that, and quite a few of them that are having negative trends. And so when you have a pool of buyers, I think they're going to gravitate toward potentially the higher trending businesses, even if they have to pay a slightly higher multiple for those. So that's kind of, I think that's what I've seen, but it's really hard to tell because, again, it really boils down to the business that you're launching and, all the metrics that go into it, Yeah,
I pulled a whole bunch of data from the dashboard before the call here, guys. I want to point out, we all know that 2021 was a frenzy, and it was in all of M&A, not just the digital world because of the aggregators. Yes, in 21, in the first quarter, we closed 7 deals with aggregators. We had 26 deals in the first quarter. 7 of them were with aggregators. Big percentage. Year to date, we've done 24 deals and just 1 to aggregators. You want to hear a really funny number is that in 2021, in the first quarter, we did 34 million in closed transactions. In 2023, we've done 55 million in total closed transactions. Now, what happens as Quiet Light grows? What happens? Our deal size grow, right? In quarter 1 of 2023, David Newell closed one for 26 million. So that one alone is what puts us $20 million ahead of Q1 2021. I personally know that I came out of 2021 just wiped out and exhausted. It was a euphoric time, but trying to keep up with 10 or 15 offers per listing. Even though, as I say that, one more stat is I think the offers per listing is actually down slightly, but as you pointed out, the multiple hasn't changed all that much. Now it does on deals that are trending down. There's no question about it, but the mean multiple in 2021 first quarter was 3.04. That's not including inventory. The largest was 5.7. With inventory, it was 3.3. Year to date, or in first quarter, so I pulled comparable stats, it's 3.1. So 3.04 2 years ago compared to 3.1 now. Now, again, though, everything has to be taken with a grain of salt because our deal size is a little bit bigger, and that $26 million deal may bring things up a little bit in terms of the numbers. But it feels so hard, as you pointed out, Brad. Sometimes, you're working on financing for a deal, and it feels so much more challenging today because it was free money. It felt like at zero interest rate back in 21. And I think that feeling is absolutely accurate because we've all seen deals go sideways or take a little longer to close because of the financing component that may come along with it. Have you
Yeah, that's an interesting point that you're making because the data actually kind of shocks me, which actually I will say, I don't know what the stats are at Quiet Light on aggregator deals, but I think I've closed 13 or 14 of them.
Oh, you've closed the most. Yeah.
So maybe my 2022 felt so rough because I had grown very accustomed to the aggregator buying my deals. Now I will tell you, I feel like this is anecdotal as well. For one, Woz was subtly letting us all know that he's outperforming everybody around here.
Add to volume to the number of deals, Brad.
Was that subtle? I think we all got it.
Yeah, maybe it wasn't subtle. No, Woz is doing great. Everybody's got him he's in my sights. I'll just say that.
That's what you used to say about me. Now I'm just a distant memory. It's Wozniak now. I like it.
Joe's gotten to the point where he doesn't have to do deals anymore. He's actually where my sights are. But anyway,
you don't have to do deals when you're in Cooperstown. That's kind of what he's doing.
That's right. If you're in the Hall of Fame, it's just kind of like whatever, man. But no, it's interesting that you guys say that because I'll give you an example, and I won't be too specific, but I have represented a lot of Amazon FBA sellers. Did sell many to aggregators, and I felt like I kind of accidentally caught an early wave on the aggregators. A couple of the big ones, I was involved in either first or second deals, and I felt like that gave me some exposure to some higher ups that I even got to a point where when people on their teams would say no, I'd go directly to the CEOs and founders and say, hey, man, this seems like a deal you guys would want. And then they'd scoop up and buy it anyway, which I'm sure their team really loved that I was out there doing that. But one point I'll make about it. So I've got a deal that's in the closing process right now, and really great Amazon FBA business, high margins, pretty large deal in terms of our average size, and got it under LOI with aggregators in the fall and really started to feel the pain from those aggregators due to internal problems with those companies. A lot of shakeup in teams, a lot of people being let go.
Are we talking fall of 21 or 22?
We're talking fall of 22, actually.
Okay.
They backed out, a couple times. And this is a business that's growing like a rocket ship. But one thing that's interesting, and it's 5 years old, but one thing that's interesting there is when we were going to first list it in 2020, before COVID hit, and we put a pause on it when COVID hit, we were looking at, a multiple around 4x. And this is a pretty sizable business. We ended up coming in on this one. We're going to be at like right around 3 all in on a business with around 2 million in EBITDA and really high margins. So it feels like things have pulled back to me a lot because I've had trouble with some of the Amazon FBAs specifically. So I wonder if inside this whole like euphoria, non-euphoria kind of situation that we're in, if Amazon FBA has pulled back more than others. I don't really have much real data, But I just kind of wonder that anecdotally. Now, I will say content for me has continued to do extremely well, no matter when I get it, no matter where I get it. And even when I do like distressed content, things that have a lot of problems on them, I still get lots of calls and get things set up where I'm able to still find buyers, for those. Now, on the content, it's always interesting to me because I don't have the 15 offers ever with the content, but I always have a steady like 2, 3, 4, 5 people that are like super interested that'll take
I think
them.
that's because people understand what a physical product is versus and how to make money. You just sell it versus how do you make money on content. But I'm with you. I love content too. It's just the margins are huge. There's danger. If you got one content business, it's better to have 5 or 6 in case there's an algorithm update. But for sure.
It would. What Woz and Brad were saying, just to kind of elaborate a little more, I kind of saw the same thing. You know, I had one that got 19 offers, which just is insane. It just ran so fast. And then so many businesses that I saw when they went out, they were going down really quickly. If nothing else, you had just had 5, 6, 7 meetings quickly because people are trying to beat everyone to market. But if you look at it in reflection, there were a couple of things that really sort of buckled. Aggregators bought quickly, had a little problem integrating, and they kept buying versus going to integration. I think that sort of buckled some of them a little bit, at least on a pause, which could have been a great thing. Some of the good things that could come out of this is that they watched their books a little closer when, interest rates got, in a position where they started to go bad, because there's always ways you can save some money. I feel like coming out of this in late 23, early 24 is going to be really, really strong, because I think there's a lot of sellers out there that probably went through some difficult years with the shipping issues and whatever you have, inflation, that may be pausing because their SDE could have gone down or their trends are a negative. Because we did a good job reinforcing in 21, hey, you need to always be on an uptrend, be on an uptrend, be on an uptrend. The people that are smoother down now are probably waiting a little bit of time. So I think there'll be a boom of a lot of people, and I think the market will recover. I think it's getting better. I'm just not, it's not back to the levels it was in 21, because those were kind of crazy. The money was just too easy, and keeping buying, you thought it could never go bad. And clearly some people misjudged whether that was a possibility or not.
Brad, Pat, can I ask you all a question kind of around that? Like, do you think that they're like, when you're, Brad, you mentioned getting a ton of, ton of buyer volume. Is that for Amazon FBA businesses or in general? Because then you said kind of content, you don't get that type of volume because what I've experienced is it's so deal specific, and I just haven't had a lot of FBA deals, honestly. So I can just go off of the ones I have. But like I just launched a tiny SaaS business, and I got really good response on it, really good interest, really good buyer intent. Then I launched it's kind of a content site, but it's more like a newsletter, and the interest has been very mediocre. And I feel like it's priced very well. It's a not 7-figure EBITDA, but high 6-figure, and it's at a 3 flat multiple. And there's some things about it that, are a little bit different, which may be part of it, but like, I'm interested to hear from you guys if you feel like it's the type of online business has some bearing on the type of, volume and kind of interest you get on those launches.
100%. I mean, you could launch 2 businesses that are doing equal amount in revenue and profit, and just get 10 times the response on one, because it's maybe even the cool factor to it, or the amount of workload or the age or history of things of that nature. I do want to touch on something, because Brad, you said, gosh, it feels like multiples are lower now. I wonder if it's just Amazon specific and things of that nature. I'm a little shocked, and I want you guys pull this data from the deal dashboard, but I had to run it 3 times when you guys were talking. What I did was I just went specific to Amazon, e-commerce Amazon. So a combination of Amazon and just Amazon and their own websites. The average multiple for those businesses in 2021 Q1, 3.5 multiple for Amazon and Amazon e-commerce combined. Q1 2023, what do you think it is? Higher or lower? Let's just go that way.
I would have thought lower.
I would still say lower.
Mm-hmm.
I'd say pretty close, maybe.
Shockingly lower, 2.14.
That's my experience with that personally. That there's been now it's starting to make sense to me though, Woz, because all I do is look at what Woz is closing, and then I'm jealous. But I don't I don't look at the actual deals. So what you just cited, Joe, is kind of what I feel like I've lived through over the last kind of year and a half, because I've indexed pretty heavily on Amazon and e-commerce sellers. I do get a fair bit of content, and, kind of back to your question before, Chris, I mean, for me, content since the day I started never gets the inquiries, not even close to what I see on e-commerce, but the buyers are very serious.
Yeah.
And it's just like, that's just been, I don't know how I would like measure it exactly, but I will tell you when someone comes along and says, hey, I'm in content, I'm interested in this, like I think to myself, this guy could be the buyer. I see that with e-commerce all day long. And I'm like, who knows who's going to be the buyer, but I'll see one person come through and I'm like, I had a deal recently, I've done quite a few in the finance space in the last several years. I got a deal that I listed for a previous seller 3 weeks ago, like a $500,000 finance deal, and had two calls on it from two really good buyers. I knew they both were like potential to buy it. Wasn't super thrilled with the response otherwise. It wasn't like I had tons of people, coming to the table. And then, the one guy I knew from dealing with him before, that he was very methodical about how he moved through the process, that he was not a guy that like rushed to go to LOI. So I gave him a couple of days. I sent him a note. Hey, just wanted to check in. He's like, yeah, I'm still thinking about it. Comes back 3 days later. He's like, hey, I am still thinking about it. I'm thinking about a full price cash offer. They said, I need a couple of days. Then I come back. We negotiated a tiny bit on it. And he said, hey, we'll get this done. I'll get it done by May 15th. And they texted me 2 days ago and said, hey, we've been working together on this. And sorry, we accidentally left you out of the loop on it. We're ready to close right now. And so they're in the closing process. That is a very typical situation for me with content.
We're recording April 26th, folks. So that's like almost 3 weeks faster.
Yeah.
So that's awesome.
Yeah. And that is something I've seen over and over again. Content's the only area where I've had 1 week closings. I've had 2 deals that closed 7 days on content. So I feel like content is one of those things that's like the supply of good content is much lower than the supply of good e-commerce. And maybe the buyer pool is smaller too, but when people see what they want there, they move fast because, like Joe said, the margins are really high. And if you know that industry, it can be a really lucrative, kind of space to hang out. But back to what Joe said, that decline that you just cited, I feel like I've lived through that. And that's been hard. So just if you're listening to the pod and you're thinking about this, 3.5 down to 2.14, is that what you said?
Yeah.
So that drop just sounds like, wow. I mean, it's down, but you got to think about it from the advisor perspective where we're launching a listing. We got to base it on data that we have in the past. So when we get to early 2022, I'm using data from the last 6 months to figure out what multiple to list at. So I'm out there listing at 3.5, let's say. So I list at 3.5 and then I don't get good response. And I'm like, what's going on here? And I'm telling and the seller's like, hey, you told me that your data showed this. I'm like, that's true. My data did show that. You know what? We might need to consider a price drop or might need to consider waiting. We talked through these things. And on some of those listings, we end up lowering the price, but getting those expectations of buyers and sellers to align as the market is moving. That's why I call 2022 a year of transition for me, because that move from 3.5 down to 2.14 on some of those businesses, I feel like I was living through that transition and I didn't know what it was. So I'm just like, I'm using the data I had. And then I start closing deals at lower numbers and that becomes the new data. And then that's created bullish activity for me for this year, because now I'm like, hey, we were listing here, but now we know to be more conservative. So I've actually been quite a bit more conservative, especially on Amazon FBA.
I want to throw a grain of salt to all of this for people that are listening, because I don't want you to go, oh, well, multiples are down from 3.5 to 2.1 for Amazon businesses, because it's not necessarily just that. We do have a smaller data set, right? This for Q1 of 2023 versus 2021, there were more Amazon businesses sold then than this quarter. And the other piece of information is that, look, we came off of a record 2021 for everything, shopping online and everything. That drove revenues up. That created part of the frenzy. 2022 was a year of transition. They're selling in 2023 Q1. What's happening in a year of transition? You're coming down, you're leveling off, you're not growing as rapidly as you used to. You had freight charges, your margins are tighter, and your discretionary earnings are probably trending down or off compared to the same period 12 months ago. So all of that would indicate a lower multiple and push multiples lower. on top of the smaller data set as well. Go ahead, Pat.
Woz, let me ask this to you, because I started thinking about this one time too. I think Quiet Light's multiples should be inherently higher than most, because like if I hear someone that's coming in, I don't know what your mentality is, coming in still at 2.1, 2.3, 2.4. They've had this business 10 years. I'm like, maybe give it 9 months. If you've gone through a tough inflationary thing and we turn away people, they're going to have lower multiples. So they work on their businesses to help them maximize that exit. Typically, we're not going to list things or hope to not list someone that's going to have a really low multiple, because we want them to improve that. That's kind of when we become educational. Do you think that has any impact on how our numbers would be seen against others? I'm not sure if you think that might be a factor, but I know our approach is different, which means some of those lower multiples we not even be selling at anyway.
That's a good question, Pat. I think it's hard to say, because I mean, me personally, when I talk to a seller and I'm doing a valuation, one thing I make sure to tell them is, what I can guarantee you is when I give you a valuation range, it's going to be something that I think I can achieve, and it's definitely not going to be something that I think you want to hear. And I tell all potential sellers that, and I think they're appreciative of that, because at least they know I'm going to shoot them straight. But it also, I can't speak to how other companies do it, but if somebody comes to me and they've been quoted a much higher multiple than maybe what I think the business is worth, I think, to your point, that the education part of that is so important. You got to establish some credibility when you're talking to sellers, and
right.
And find out, look, is there a reason why he was quoted a 4.5 multiple? Maybe there is. Maybe there's something.
Probably includes inventory. That's number one. So they quote it with inventory included.
Yeah. But if it's something like they have multiple patents and the product or whatever is truly unique, those are other considerations. There's a million considerations. But I think, we're such a white glove service. We're not so much a marketplace, but we put these packages together ourselves. So we really get to learn the business. But I think all things being equal, I mean, I think I think Quiet Light's reputation, I think we could be on the higher end of a range of multiple for, comparing apples to apples. I would think so.
I think so as well. So I want to throw something in there, go back to the data. We're showing that the Amazon oriented businesses, the multiples are down, but the multiples are up overall. And so that means that there's other businesses that are filling up sort of that Amazon frenzy void that is straight up e-commerce or content or SaaS. Now, content and SaaS multiples tend to be higher anyway. So that's probably what's pushing it up a little bit. I think David's bigger deal was a SaaS deal. And Woz, you just closed a very large one, didn't you? That took a while to close. I think you did close it, but that was e-commerce, right? The
e-commerce and an agency that got a really good multiple.
Okay, good. I was naming the agency and the e-commerce business on the tip of my tongue, and I'm going, don't do that. Don't do that.
Don't do that.
I was about to do a beep at the same time. You know what? Actually, to that point, I have dropped my multiples on some of these things myself, but not to the level of the data that you cited. I found that I've gotten really strong interest just by taking it off a little bit. There was a period in 2021 where I would call peak euphoria. It was around May of 2021, where we were listing Amazon FBAs at extremely high multiples. There was even an email that was circulating at one point where someone was saying, I'm looking between 5 and 6. For everything I'm looking at, and I'm going, there's something wrong here. This is not going to last. But no, I haven't 2.14. I'm not out there listing any Amazon FBAs at 2.14. I'm still seeing strong activity there. And if you go pre 2021, if you go to 2019, Amazon businesses were selling at a discount back then. They used to be a lower, they used to be our lowest multiple from what I remember. And they really have gained a lot of credibility over the last several years.
I'm digging further into the stats, and maybe I should have done this to begin with, but it's interesting. The mean multiple with inventory is 3.55, but the mean average multiple is 2.14. And as I look at the dotted chart, there's a sizable business that was sold. I mean, for next to nothing. I think actually is that the one where it was negative 70,000? Somebody did a deal where I think the seller had to give the buyer some money and then they bought all the inventory or something along those lines.
That could be skewing the data.
It's definitely, even though it says mean, it's still skewing it a little bit, for sure. Hey,
I want Amazon reseller in there too, Joe,
yeah, exactly. So small data point and a couple of funky ones in there. I wanted to talk about lending because, again, our deal sizes are getting larger. In 2021, it was 1.4 million in the first quarter. And year to date, first quarter of 2023, it's 2.2 million. And so as deals get larger, there's generally, more of a need for some type of financing. Woz, I think you had a call with Steven Spear from e-commerce lending today or yesterday, just to get a vibe from him on what's happening in the lending market. Can you talk about that a little bit?
Yeah, I just wanted to call him just to get his perspective on it because he sees a lot of deals. He said year over year, 23 to 22. So, basically January through, we talked last week, so about mid-April, the volume on deals is basically the same. So not much difference there. Where he saw differences are with kind of the underwriters' scrutiny of deals. Not that they're putting the businesses under a microscope way more than they did last year or anything, but more so they're asking more questions. And this is on the SBA side, by the way, not the capital markets program that he has, but from the 7A loan world, he's seeing the underwriters requiring buyers to have more kind of transferable, relatable experience. He's seeing deals maybe taking a little bit longer than normal, which, we've all been through it. Like, how long is that? Who knows?
Yeah. Well, why are they scrutinizing things more on SBA deals? It's the aggregators that imploded. Is it just because banks are nervous?
Yeah, I think they're seeing, because SBA preferred lenders are not scared away necessarily by declining trends. Like the big e-commerce deal I closed, they were on a roll of probably 10 months of pretty substantial year over year trends, like downward trends. So I think they'll still do the deal, but I think they're more concerned about their debt coverage because, it's coming at them from both sides. You've got higher interest rates. I mean, prime is like whatever it is, 6 or 7%, and they're usually 2.5 above that. Whereas I think last year at this time, they were still sub 3, maybe. Maybe that's 2021, early 22. But so they've got the payments are higher, the debt service is higher. You've got a business that is maybe trending down a bit, but hopefully maybe kind of bottomed out and normalized a little bit, or not normalized, bottomed out. And so I think they're not worried, but just a little more. They want to give it a little more time through the underwriting process to kind of see how the company's doing. And then that's also the reason for wanting to make sure they're lending to a borrower that I think can run the business well and hopefully turn it around. So I think that's probably a couple of the reasons.
Are they looking for more financial stability from the buyers because of the potential, fluctuation in interest rates? Because correct me if I'm wrong, all three of you, but I think the SBA deals that I've heard about recently from Steven are variable interest rates. So as interest rates go up, the payments go up as well, or at least maybe the payments stay the same. Help me out, guys. Did the payments stay the same, but the interest rate goes up and it's just the amount going towards the base goes?
It depends, but most 7As are variable. And, those over a 10-year term, it doesn't change their payment that dramatically, even when the rates go up, but it does increase the payment. And I've had sellers cite, about a 20% increase in payment cost on their loans due to the rates moving, prime plus, which I actually think that prime might even be higher than that. I think it might be like 8 point. For some reason, I think it's in the 8s now. Maybe I'm wrong about that, but and then they're adding maybe 2.5 on top.
I think it was interesting how Chris Duty pointed out that he actually feels badly for the people that got those low interest rate loans back in 21, and now they're at 8-9% because they weren't prepared for that financially, versus the people that bought the business where it was, the financial model included interest rates at 8 or 9%.
Yeah, that kind of cuts both ways though too. It's kind of like if someone buys a house today, if we sometime in the next 2-3 years get back to business as usual, what has been the monetary policy of the last 20-25 years in this country, those people will be refinancing those loans and seeing their payments cut in half if it goes to anywhere near what we've been used to. Same thing on the SBA side. People that do businesses now through the SBA might see some nice reductions in kind of payments due. I've seen a little bit of caution, just to Waz's point. I feel like there's a little bit more caution in the air in general, and I've seen it on the legal side. I actually have had some deals get more caught up in legal than I was prepared for. And at first I thought it was just a deal by deal, but I've actually had it happen on several deals now where I can tell that the legal is getting a deeper look from both buyer and seller or lender about terminology, about things that are written in there. And I think that really just kind of speaks to that we're in more cautious times, that people are just trying to be really careful, with their things. I've had deals drag out. I don't think that they're not closing. I've closed quite a few this year and have quite a few that are in the pipe to close, but I have seen a little bit of a delay on the legal side, as it sometimes it relates to the lending, but sometimes it's just on legal.
Yeah, I think when so much is up in the air with the economy and the war and inflation and all this other stuff, people always get more in tune to the fine details of business.
For sure.
And understand that it's not always going to go up. Things can go down as well, too.
Are you guys seeing?
Waz, let me ask you a question about, did it come up in your meeting about the new SBA regulation where you can either, I don't think it's rolling equity. I think it is rolling equity versus, or seller notes that'll be allowed. I think it's May 1st. Did they talk a little bit about why that changed? Did they just miss out on a lot of deals because those were part of the structure and now they're going to address it from that standpoint? Is that?
Yeah.
Did he talk to you about that?
Yeah, we did. That was kind of towards the end of our conversation, but yeah, he said, that the SBA, as early as May, I think he said the end of May, but maybe he said May 1st. I thought he said end of May. They are, according to him, they are going to allow for sellers to roll equity in the new co. That's actually borrowing the money from the lender, the SBA preferred lender. So, previously that wasn't allowed. A seller couldn't retain any equity, period.
Right.
And in this case, if the seller were to retain up to 20% equity in the new company, they're not required to sign a personal guarantee. So I think that's going to be, a kind of a game changer, because
I agree.
I'm sure you guys see it. Like there's this kind of area where, if it's a $5, $6, even $7 million deal, that could be an SBA deal all day long. And my e-commerce one, which was larger than that, was an SBA deal, and we were able to kind of structure it up to get it done. And there's a little, it seems like there always has been a little gap between what's an SBA deal and then a deal that's too small for financial buyers, where you're at $2 million, $2.5 million of EBITDA and the multiples go up, and you're kind of, if something's in that $1.5 to $2 million range of adjusted EBITDA, SDE, and you're in that kind of no man's land of it's too big for SBA, like you couldn't structure a way to get it done. And then it's below the radar for the financial buyers. And so I think this 20% equity, in my simple way of thinking, would basically allow for a 20% increase in potential value on any deal that went SBA, if the seller's willing and wants to retain equity, and if the buyer, of course, wants that as well. But I think, Pat, to your point, the reason this is happening is because I do believe a lot of lenders missed out on a lot of deals where some type of equity roll was desired by both sides of the deal, and so they finally, I think, went back to the drawing board. And hopefully we'll see those changes by the beginning or end of May, which will be huge. I think
that's really exciting.
Yeah. So Waz, are you saying, like, let's say that there's, I did hear this, but I wasn't thinking about how this would help us structure larger deals whenever I was thinking about it. So with a $5 million cap on SBA, if I have a $9 million deal, and the seller was willing to roll, let's just say 40% of that deal, someone could go get a max $5 million loan and the seller could retain 40% of that. And you're doing a $9 million deal on the valuation, but you're only doing a $5 million loan.
I think if I understood correctly, you could do that, but then the seller would be required to sign personally on the loan as well.
Gotcha.
Because it's above 20.
Up to 20 without the
up to 20
guarantee.
Without a PG.
Yeah.
All right.
Yeah.
Hey,
still good. I still like it.
I like it
Really
too.
good.
I like it too. I'm going to call on you, Brad. Will you explain to the people that are listening the benefits both to a buyer and seller of rolling equity?
Sure. So the benefits to the buyer of someone rolling equity is key man risk is a huge problem in our industry. You get into any large deal and the buyers, especially if they're private equity, are going to be very concerned about what does this entrepreneur know about this business that we don't know. We don't want to write this guy a check and have him just disappear off into the sunset with his money. We'd like to keep him tied in. And so in private equity deals, it's very common that equity is rolled. So basically just you're keeping some percentage of that company. You might create a new entity, but you're creating some percentage of that company. On the other hand, from a seller's perspective, equity roll creates kind of two benefits from my perspective. One, it increases the buyer pool, creates more of a market for your business is one big thing. But the other, like in the case of my larger private equity deals, I've had two larger private equity deals where my sellers rolled equity. That ends up being an opportunity for them to get a second exit. So, take an instance like my friend Johnny, we sold his business and, he rolled some percentage, into the new entity. And so when he rolls that percentage in, the private equity firm comes in, they hire a new CEO, they hire a new logistics manager, put all kinds of infrastructure in place, start scaling up the operation. And he's got equity in that. And 5 years down the road, when they go sell it for 3 to 5 times as much, he's going to get a check that looks similar to the one that he got when we exited the first time. Mm-hmm. And so that's the benefit I see for sellers is gives them a bigger buyer pool to choose from because people are more comfortable buying businesses that keep the key man involved and also gives them the upside down the road.
In Johnny's case, what kind of work on a regular basis did he have to do?
Well, that was a big deal. So, that was a substantial, 8-figure deal. And so in his case, he was CEO for 2 years.
He was. They kept him on as CEO. Yeah.
Yeah. He stayed on as CEO, but it was one of those things when I start talking to people that are going to be doing like a $20 to $50 million exit, I'm telling them up front, hey, there's probably not a great path here for, get your check and just run away. You're probably going to need to be prepared for this to be a process. And we're going to plan for your exit. And it's going to take some time to get through it, but we can definitely get you there.
Yeah, while you're bobbing your head up and down, you just closed an 8-figure deal. What happened to the seller there? Did they have to stick around for a while?
It was an SBA deal, and it was just shy of 10 million. And the owner, so it was two guys who ran the business. One was the owner, and then his good buddy was not an owner, but he profit shared. And so to get to the deal that we wanted to get to, they had to retain some equity. The issue is it was being financed by the SBA. They didn't allow it. So the good news is we were able to get the guy, not the owner, but his buddy that profit shares in the business and works in the business. He retained 15% equity in the new co.
Okay.
So it got the deal to where it needed to be. And then the owner and the new equity owner and the new co are going to work that out themselves, and they are. And then we had, I think, a little bit of seller note, maybe that was attached to the inventory.
Did the sellers have to help operate the business like Johnny did for 2 years, was where he retained the CEO title? Did your guys have to do that at all?
The owner has a 1-year employment agreement,
okay,
with a pre-established salary, and then the guy that's retaining equity, there was nothing I don't call permanent in place beyond like a 3-month pretty intensive sort of training and transition period.
Cool.
Yeah.
I've got 3 of the most prolific brokers on our team on the call right now. So I'm going to switch it up here, guys, as we move towards wrapping this up. What are you working on? Like what's coming up in the month of May, second half of May that you're working on? Pat, you want to kick that off? You working on anything now that will list that?
Yeah, I mean, I have some listings I'm working on that be coming to market, some pretty good ones. I have some current ones that are, have some success, some that are struggling a little bit. I think the thing that I've tried to do, I'm working with a lot of entrepreneurs that I have in my active list that I'm working with month to month to try to continue to work with them. People that either have a stagnant or dropping business a little bit that still are focusing on how they can improve it over the next 6 to 9 months and resetting their date of being able to do it. I love investing that time with those people and spending time going through the financials. So I'm spending a lot more time laying seeds with people, helping them improve their business to get ready to sell than I am taking to market.
Yeah.
But I still have some good things coming up this year that'll be good. I have a couple of big ones that have a chance to close. But I like how the market looks and actually like this kind of opportunity because I think we at Quiet Light always want to be as educational as we can possibly be. And that's what I'm being way more of than anything that's listing. So that's
and that pays off.
Is great. And
that pays off. We all know that helping first comes back around for sure.
I'll also be out going to, I think I'll be in Puerto Rico at $1 Billion Seller Summit. I think Brad and Woz, I'm not sure if you're going to Fort Lauderdale. I'm going to be out for a lot of shows. I'll be in Vegas for the Shark Tank reunion. I'll see 150, 200 companies there. It's exciting.
I'll be here in Davidson mowing my lawn while you guys are doing that stuff. Woz, what do you got coming up? Are you working on anything now that's going to be listing in the next 30, 60 days?
Yeah, I've got a couple. It's been kind of weird for me in the past few months. I had some good closings, 3 of them. So I'm not, I'm probably half at Brad's clip right now. So that'll probably keep, going.
Let me just say it for Brad. Are you kicking back because you've been crushing everybody historically? Like you brokered more deals in the last 12 months than anybody. So you're just taking it easy. Is that what's going on here?
Me?
Yeah. Pause. You meant the new Brad.
I meant the new Brad. I meant Woz. Yes, I meant Woz.
No, I haven't. I've just, you run into these things when you do this long enough. You run into these weird, like, they're not ruts. They're just like, people maybe put a pause or something happens in their life where they're just not responsive for a little bit. And I feel like I'm kind of coming out of the other end of that after a couple months of kind of weird things, but that's just part of it. But yeah, I've got a couple good businesses that'll be launching probably within the next couple weeks. I just launched a little SaaS business, $95,000 SDE, and 4.5 multiple on it. So that's awesome. And then, Amanda and I are working on a pretty sizable one that we've been talking to these sellers for a year. And really it's really revolved around valuation. So I'm, hopeful on that one.
Sizable, and what kind of category? We talking, how big is it? And we talking e-commerce, content, SaaS? What are we talking about?
It's Amazon and e-commerce, and they're getting to the point where they're about half and half, about $2.5 million EBITDA, adjusted EBITDA. Okay. Yeah.
All right. In the audience, if that's what you're looking for, reach out to Woz or Amanda. It's Woz at Quiet Light or Amanda at Quiet Light. Very cool. Very cool. Brad, what you got going on?
I'm busy.
Being managing director now? That's taking up all your time?
That's taking some time for sure. But also busy with deals. And got a couple that are coming up in the next few weeks. Got an Amazon FBA business that'll be SBA pre-qualified. That will be somewhere around 1.25 million plus inventory. Good business with good margins. Also have an interesting one that's a guy that's selling Shopify stores that are ready for dropship businesses. So they're selling kind of plug and play. And they've done really well building this out, and they're making really good money on both Shopify affiliate commissions and by selling the service of building these stores out for people, kind of up front. So I'm excited about those, but have a lot going on. In fact, Pat, I may not go to $1 Billion Seller Summit because I'm worried I've got too much work to do. Puerto Rico for a week does sound like a lot of fun, but I'm worried about getting too far behind. So
wait a minute, it's in Puerto Rico. Oh,
yeah.
My wife can mow the lawn. Maybe I'll go.
Yeah, you might have to take my spot. I want to go, but I really am struggling. I'm going to be doing a kids camp the week before, so I'm like really worried about not having the office time. But I will be in Fort Lauderdale with Pat in a couple weeks, and looking forward to that.
Is that for Seller Summit?
Seller Summit. That'll be a great show.
Yep. Steve Chu's got a new book coming out called Family First Entrepreneur, folks.
Yeah, I saw him speak about it at ECF.
ECF, yeah.
Great guy.
Yeah. His podcast airs, I think, the first week of May here, and it's going to help. We're trying to help him get to the Wall Street Journal bestseller list, so he can be just like Walker Diable. Hey, I wanted to mention something. Going back to you, Woz, I interviewed a former client of yours last week, and I've been on Frenzy, so his name escapes me at the moment. But what he said does not. He said Chris Wozniak has no pulse. I'm like, what are you saying here? What do you mean? He goes, he is so calm, cool, collected. His pulse never goes up. It never goes down. His tone is always the same. He's awesome. So there you go. Guy was very happy with you.
No better thing you can say about an M&A broker than to have nerves of steel like that.
That's it. Yeah. That's really what he was saying. No pulse means nerves of steel, for sure.
Really nice of him to say. Thanks for sharing that with me.
Yes, you're welcome. Well, guys, any last minute thoughts you want to share with the audience in regards to deal flow, acquisitions, trying to sell, lending, anything else that you want to share?
Get as much information around you as you can. If you're wondering about your valuation or where you want to go, reach out. Let us try to help and talk to you. It doesn't cost anything. We just help guide.
I think the market is in a better place than the news is reporting right now. There's a lot of, especially if you hang out on like financial Twitter, of everyone saying like, oh, the wheels are going to come off, the wheels are going to come off, the wheels are going to come off. We've already been through a pretty substantial amount of pain. And we're watching that inflation number tick down. And I think the earnings of publicly traded companies continues to surprise people. We're seeing that right now. This is the third earnings season in a row in the quarters where I've had friends in my trading groups and stuff saying to me, oh man, this is it. Everything's going to go, everything's going to tank, all this stuff. And I'm thinking, the economy actually is showing some resiliency against some of that. And so I feel like we'll bottom. We might have already bottomed, and we'll show resilience first. Because we got hit pretty hard as the market came down, in my opinion. So I really think that the market is in a good spot. And if you're thinking about allocating some capital to a new business, like I think this really is a good time to be buying. It seems like the activity is really starting to pick up, and I'm seeing a lot more stability there than I did last year personally.
Yeah, I'd kind of piggyback on that also, just for sellers and even buyers that are listening, that, I was in the industry basically right off of the .com bubble, but I was right there when the financial crisis happened. And, you can read all the stuff and Google everything that you want on the economy and all that. But what I know from experience is that at the end of the day, sellers still need to sell their companies, and there will still be buyers in those periods. Matter of fact, I even think even if the volume of buyers drops off, the cream rises to the top a lot in those situations where you have buyers that have more liquidity. They may be savvier. They may not be as afraid of downward trends because they know historically those are going to turn around probably sooner than later. And they have the financial wherewithal and experience to pay a premium for something that's doing well. So I just wanted anybody listening to keep that in mind. I think we've, to Brad's point, weathered the storm really, really well.
I think you're absolutely right. And to your point there, we've had an average of 2.9 offers on every listing so far this year. That's typical for us. Sometimes it's a little higher, but you're getting almost 3 offers on every listing. Tells us that there are plenty of buyers for these types of businesses. I want to throw out one more thing, and that's quietlight.com/partners. For those that are listening going, what, Brad, Woz and Amanda are going to have a big deal, SBA qualified, or Brad's going to have one. I've got to find a lender. There's a list of lenders on the /partners page that you can work with, that we've all worked with before. All right. Well, guys, this is our first podcast with Brokerage Roundtable, and I loved it. Thank you so much. Woz and Brad, thank you. Pat's going to do the next one with, I think, maybe Elaine and John. We're going to try to do it once a month. Appreciate you guys coming on.
Thank you.
Thanks for having us. Yeah.